Question 1. Performance analysis shows that a significant number of customer complaints regarding policy claim denials are being resolved by offering a partial payout without a detailed explanation of the denial or the basis for the partial settlement. This approach aims to reduce the average resolution time. Which of the following approaches best aligns with the regulatory framework for complaint handling in the context of the Insurance Company Operations Exam, LOMA 291? Option A. Delay the response to the customer by requesting additional documentation that is not strictly necessary, thereby allowing more time to formulate a less favorable resolution. Option B. Conduct a thorough investigation into the claim denial. Clearly communicate the findings and the specific policy provisions or regulatory reasons for the denial, and explain how the partial payout was determined if applicable. Option C. Inform the customer that the claim denial is final and that no further discussion or compensation will be provided, as this maintains consistency in claim adjudication. Option D. Immediately offer a partial payout to the customer upon receiving the complaint, as this demonstrates a willingness to resolve the issue quickly and reduces the likelihood of escalation. Correct answer is B. Conduct a thorough investigation into the claim denial. Clearly communicate the findings and the specific policy provisions or regulatory reasons for the denial, and explain how the partial payout was determined if applicable. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient complaint resolution with the imperative to adhere strictly to regulatory requirements for handling customer grievances. The challenge lies in identifying a resolution strategy that is both timely and compliant, avoiding shortcuts that could lead to regulatory penalties or damage customer trust. Careful judgment is required to ensure that the chosen approach not only addresses the customer's immediate concern, but also upholds the company's commitment to fair and transparent complaint handling, as mandated by the relevant regulatory framework for the Insurance Company Operations Exam, LOMA 291. The correct approach involves a thorough investigation of the customer's complaint, followed by a clear and comprehensive explanation of the company's decision, referencing the specific policy provisions and regulatory guidelines that support the outcome. This demonstrates a commitment to due process and transparency, which are fundamental to regulatory compliance in complaint resolution. By providing a detailed rationale, the company educates the customer and reinforces its adherence to established procedures and legal obligations. An incorrect approach that focuses solely on offering a quick settlement without a proper investigation risks violating regulatory requirements for fair complaint handling. This could be seen as an attempt to avoid scrutiny or to prematurely close a case without due diligence, potentially leading to regulatory sanctions for failing to adequately address the customer's concerns or for not following prescribed investigation protocols. Another incorrect approach that involves delaying the resolution process without providing regular updates or clear reasons for the delay can also lead to regulatory issues. Such delays can be interpreted as a failure to meet service standards or a lack of commitment to resolving customer issues promptly, which are often addressed in regulatory guidelines concerning customer service and complaint timelines. A third incorrect approach that involves providing a vague or incomplete explanation for the resolution without referencing specific policy terms or regulatory basis fails to meet the transparency requirements. This can leave the customer feeling unheard and can also be a point of contention during regulatory reviews, as it suggests a lack of clear justification for the company's actions. The professional decision-making process for similar situations should begin with a clear understanding of the applicable regulatory framework for complaint handling. This involves identifying the specific requirements for investigation, communication, timelines, and documentation. Professionals should then systematically gather all relevant information pertaining to the complaint, conduct a thorough and objective investigation, and formulate a resolution based on policy terms and regulatory mandates. Communication of the resolution must be clear, concise, and well supported by evidence and regulatory justification. Finally, all steps taken should be meticulously documented to ensure accountability and facilitate future reviews. Question 2. Implementation of a new integrated policy administration, claims processing, and billing system is nearing its go-live date. The project team has identified a critical bug in the claims processing module that, if not addressed, could lead to a small percentage of claims being incorrectly denied. The project manager is under immense pressure from senior management to launch the system on schedule to realize projected cost savings. The project manager is considering two options: A. Delay the launch to fix the bug, or B. Launch on time and address the bug in a subsequent patch, accepting the risk of some incorrect claim denials in the interim. Which approach best upholds the company's ethical and regulatory obligations? Option A. Launch on time and implement a manual override process for all claims until the bug is patched. Option B. Delay the launch to fix the bug before going live. Option C. Launch on time and address the bug in a subsequent patch, accepting the risk of some incorrect claim denials in the interim. Option D. Launch on time and inform policyholders that claim processing may experience temporary inaccuracies. The correct answer is B. Delay the launch to fix the bug before going live. Explanation: this scenario presents a professional challenge because it requires balancing the immediate need for system efficiency with the long-term ethical and regulatory obligations of an insurance company. The core systems of policy administration, claims processing, and billing are critical to customer service, financial integrity, and compliance. A decision made under pressure to prioritize speed over thoroughness in system updates could have significant negative repercussions. Careful judgment is required to ensure that any system changes uphold the company's duty to its policyholders and adhere to regulatory standards. The correct approach involves a phased implementation with robust testing and clear communication. This means thoroughly testing the updated policy administration system for accuracy in premium calculations, coverage details, and policyholder data before it goes live. Simultaneously, the claims processing system should be tested to ensure it correctly identifies eligible claims, calculates payouts according to policy terms, and maintains accurate audit trails. The billing system must be verified to ensure it generates accurate invoices and processes payments without errors. This methodical approach minimizes the risk of errors that could lead to incorrect policy terms being applied, underpaid or overpaid claims, or billing discrepancies, all of which could violate regulatory requirements and damage customer trust. Adhering to a structured testing and validation process aligns with the principles of operational integrity and customer protection mandated by insurance regulations. An incorrect approach would be to deploy the updated policy administration system without adequate testing, leading to potential errors in premium calculations or coverage application. This failure to ensure system accuracy could result in policyholders being charged incorrectly or denied benefits they are entitled to, violating consumer protection laws and potentially leading to regulatory penalties. Another incorrect approach would be to rush the integration of the claims processing system update, resulting in inaccurate claim adjudication or delayed payments. This would not only breach contractual obligations to policyholders, but also contravene regulations requiring fair and prompt claims handling. Similarly, releasing an untested billing system update that generates incorrect invoices or misapplies payments would undermine financial transparency and could lead to regulatory scrutiny for financial misrepresentation or mismanagement. Professionals should employ a decision-making framework that prioritizes risk assessment and mitigation. This involves understanding the potential impact of system changes on policyholders, financial reporting, and regulatory compliance. For implementing any changes, a comprehensive testing plan should be developed and executed, involving all relevant stakeholders. Clear communication channels should be established to report any issues identified during testing and to coordinate remediation efforts. The decision to deploy should only be made after all critical functionalities have been validated and any identified risks have been adequately addressed, ensuring that the operational changes support, rather than undermine, the company's ethical and legal responsibilities. Question 3. Which approach would be most effective for an insurance company to proactively manage its exposure to potential financial and operational disruptions in the current economic climate? Option A. Implementing a comprehensive enterprise risk management framework that systematically identifies, assesses, and mitigates a wide range of risks, including market, credit, operational, and compliance risks, with regular reviews and updates. Option B. Focusing exclusively on maximizing short-term investment returns to build a substantial financial cushion. Option C. Relying primarily on historical financial performance data to predict future outcomes and adjust capital reserves accordingly. Option D. Adopting a reactive strategy where risks are addressed only after they have caused a significant negative impact on the company's operations. The correct answer is A. Implementing a comprehensive enterprise risk management framework that systematically identifies, assesses, and mitigates a wide range of risks, including market, credit, operational, and compliance risks, with regular reviews and updates. Explanation: this scenario is professionally challenging because it requires an insurance company to balance its financial stability with its commitment to policyholders, all while navigating a complex and evolving regulatory environment. The core of the challenge lies in accurately identifying and quantifying potential risks that could impact the company's ability to meet its obligations. A failure to do so can lead to financial distress, regulatory penalties, and a loss of public trust. The correct approach involves a comprehensive and forward-looking assessment of all potential threats to the company's operations and financial health. This includes not only financial risks, but also operational, strategic, and compliance risks. By systematically identifying, analyzing, and prioritizing these risks, the company can develop appropriate mitigation strategies and contingency plans. This proactive stance is directly supported by regulatory frameworks that mandate robust risk management practices to ensure solvency and policyholder protection. For instance, regulatory bodies often require insurers to maintain adequate capital reserves based on their risk profile, conduct regular stress tests, and implement internal controls to manage operational and compliance risks. Adhering to these requirements demonstrates a commitment to sound financial management and regulatory compliance, safeguarding the interests of policyholders and the stability of the insurance market. An incorrect approach would be to solely focus on historical financial data without considering emerging trends or potential future disruption. This overlooks the dynamic nature of the insurance industry and the possibility of unforeseen events, such as economic downturns, technological advancements, or changes in consumer behavior, which can significantly impact profitability and solvency. Such a narrow focus would likely lead to an underestimation of risk and inadequate capital reserves, potentially violating regulatory requirements for solvency and risk management. Another incorrect approach would be to prioritize short-term profit maximization over long-term risk mitigation. This might involve cutting corners on risk assessment processes, investing in overly speculative ventures, or neglecting to invest in robust compliance and operational controls. This approach is ethically questionable as it places shareholder interests above the fundamental duty to policyholders and could lead to significant financial losses and regulatory sanctions. Regulators expect insurers to operate with prudence and a long-term perspective, ensuring they can meet their contractual obligations over the life of policies. Finally, an incorrect approach would be to adopt a reactive rather than proactive risk management strategy, addressing risks only after they have materialized. This often results in higher costs for remediation, potential reputational damage, and a greater likelihood of regulatory intervention. Effective risk management requires anticipating potential problems and implementing preventative measures, which is a core expectation of regulatory oversight in the insurance sector. The professional decision-making process for similar situations involves a structured and systematic approach to risk management. This begins with establishing a clear risk appetite and tolerance for the organization. It then involves identifying all potential risks across the business, assessing their likelihood and potential impact, and prioritizing them based on their severity. Once risks are understood, appropriate mitigation strategies, controls, and contingency plans are developed and implemented. Regular monitoring, review, and reporting of risks are crucial to ensure the effectiveness of the risk management framework and to adapt to changing circumstances. This comprehensive process, aligned with regulatory expectations, ensures the insurer operates soundly and ethically. Question 4. The analysis reveals that a life insurance company is considering implementing a new, advanced claims processing system that promises substantial operational efficiencies and cost reductions. However, the system introduces novel data security vulnerabilities and potential integration challenges with existing legacy systems. Which of the following approaches best aligns with prudent operational risk management principles and regulatory expectations for insurance companies? Option A. Conduct a comprehensive, independent risk assessment of the new system's potential operational, security, and compliance impacts. Develop a detailed mitigation plan with clear control measures and contingency procedures, and then proceed with a phased implementation. Option B. Delegate the entire risk assessment and mitigation planning process to the technology vendor, assuming their expertise will fully cover the company's operational risk exposure. Option C. Postpone the implementation indefinitely until a completely risk-free technology solution becomes available, prioritizing absolute certainty over potential operational improvements. Option D. Implement the new system immediately to realize cost savings, relying on the vendor's assurances for security and operational stability, and address any issues as they arise. The correct answer is D. Implement the new system immediately to realize cost savings, relying on the vendor's assurances for security and operational stability, and address any issues as they arise. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for operational efficiency with the long-term imperative of robust risk management, all within the specific regulatory confines of the Insurance Company Operations Exam, LOMA 291. Jurisdiction, which we will assume for this context, is the United States, governed by state insurance departments and federal regulations where applicable. The company is facing a critical decision on how to integrate a new technology that promises significant cost savings, but introduces novel operational risks. The challenge lies in selecting an approach that not only achieves the desired efficiency, but also adheres to the principles of prudent risk management as expected by regulators, ensuring the financial soundness and policyholder protection that are paramount in insurance operations. The correct approach involves a phased implementation of the new technology, coupled with a comprehensive risk assessment and mitigation plan developed before full deployment. This includes identifying potential operational failures, data security breaches, and compliance issues associated with the new system. The plan should outline specific controls, monitoring mechanisms, and contingency procedures. This aligns with regulatory expectations that insurance companies must maintain adequate systems and controls to manage risks effectively. For instance, state insurance laws and NAIC, National Association of Insurance Commissioners, model laws often mandate that insurers have robust enterprise risk management, frameworks in place, which inherently require proactive identification, assessment, and mitigation of risks before they materialize. This approach demonstrates a commitment to operational integrity and policyholder protection, which are core regulatory concerns. An incorrect approach would be to prioritize immediate cost savings by deploying the technology without a thorough risk assessment. This failure to proactively identify and address potential operational risks is a direct contravention of the prudent management standards expected by regulators. Such an approach could lead to significant financial losses, reputational damage, and regulatory sanctions, as it demonstrates a disregard for the company's fiduciary duty to policyholders and the stability of its operations. Another incorrect approach would be to delay the implementation indefinitely due to an overly cautious stance on risk, without establishing a clear path for risk mitigation. While risk aversion is important, an inability to adapt and adopt new technologies that can improve efficiency and service, provided risks are managed, can lead to competitive disadvantages and ultimately impact the company's long-term viability. Regulators expect companies to innovate responsibly, not to stagnate due to an inability to manage associated risks. A third incorrect approach would be to delegate the entire risk assessment and mitigation process solely to the technology vendor, without independent verification. While vendors may have expertise, the ultimate responsibility for operational risk management rests with the insurance company itself. Relying solely on external parties without internal oversight or validation can lead to overlooked risks or inadequate controls, which would be viewed critically by regulators who expect internal accountability. The professional decision-making process in such situations should involve a structured risk management framework. This begins with identifying the objectives and the potential risks associated with achieving them. Next, a thorough assessment of the likelihood and impact of each identified risk is conducted. Based on this assessment, appropriate mitigation strategies are developed and implemented. Continuous monitoring and review of the risk landscape and the effectiveness of controls are then essential. This iterative process ensures that operational changes are aligned with the company's risk appetite and regulatory requirements, fostering a culture of proactive risk management. Question 5. The performance metrics show a significant increase in underwriting efficiency and a reduction in processing errors since the implementation of a new AI-powered underwriting system. However, internal audits have flagged potential concerns regarding the transparency of the AI's decision-making logic and the possibility of subtle biases in its risk assessment algorithms, which were developed by a third-party vendor. The company is operating under a regulatory framework that emphasizes fair treatment of all applicants and requires insurers to demonstrate that their underwriting practices are non-discriminatory and actuarially sound. Which of the following approaches best addresses the situation while adhering to regulatory requirements and ethical considerations? Option A. Continue using the AI system as is, relying on the vendor's assurances of compliance, and focus on marketing the efficiency gains to customers. Option B. Conduct an independent, in-depth audit of the AI system's algorithms and decision-making processes, develop clear protocols for human oversight and customer appeals, and update data privacy policies to reflect the new technology. Option C. Immediately discontinue the use of the AI underwriting system and revert to the previous manual process until a fully transparent and bias-free system can be developed internally. Option D. Implement a mandatory, one-time training session for all underwriters on the basic functionalities of the AI system and instruct them to override any decisions they find questionable without further documentation. The correct answer is C. Immediately discontinue the use of the AI underwriting system and revert to the previous manual process until a fully transparent and bias-free system can be developed internally. Explanation. This scenario presents a professional challenge due to the rapid integration of emerging technologies like AI into core insurance operations, specifically underwriting. The challenge lies in balancing the potential benefits of AI-driven efficiency and accuracy with the imperative to maintain regulatory compliance, ethical standards, and customer trust. The need for deep analysis stems from the potential for AI to introduce biases, create data privacy risks, and necessitate new oversight mechanisms that may not be fully addressed by existing, traditional regulatory frameworks. Careful judgment is required to ensure that the adoption of AI enhances, rather than compromises, the integrity and fairness of the underwriting process. The correct approach involves a proactive and comprehensive risk assessment and mitigation strategy specifically tailored to the AI underwriting tool. This includes rigorous validation of the AI model's algorithms for fairness and accuracy, ensuring transparency in its decision-making processes, and establishing clear human oversight and appeal mechanisms. Regulatory justification for this approach is rooted in principles of fair treatment of consumers, data privacy, and the insurer's responsibility to ensure that underwriting decisions are not discriminatory or arbitrary. For instance, regulations often require insurers to demonstrate that their underwriting practices are actuarially sound and do not unfairly discriminate. Implementing robust testing and validation ensures that the AI tool meets these standards. Ethical considerations also mandate that customers understand how decisions affecting them are made and have recourse if they believe an error has occurred. An incorrect approach of relying solely on the vendor's assurances without independent validation poses significant regulatory and ethical failures. This could lead to the deployment of a biased AI model, resulting in discriminatory underwriting practices that violate fair housing or equal opportunity laws, depending on the jurisdiction. It also fails to meet the insurer's duty of care to its customers and regulators, who expect demonstrable control over the underwriting process. Another incorrect approach of implementing the AI tool without updating existing data privacy policies or training staff on its implications creates vulnerabilities for data breaches and misuse of sensitive customer information, directly contravening data protection regulations. Furthermore, failing to establish clear human oversight and appeal processes undermines customer trust and regulatory expectations for accountability, potentially leading to a perception of opaque and unfair decision-making. The professional decision-making process for similar situations should involve a phased approach. First, thoroughly understanding the capabilities and limitations of the emerging technology. Second, conducting a comprehensive risk assessment that considers regulatory, ethical, operational, and customer impact. Third, developing and implementing robust governance, oversight, and mitigation strategies. And finally, continuously monitoring and adapting the technology and its implementation in response to performance data and evolving regulatory landscapes. This iterative process ensures that innovation is pursued responsibly and in alignment with core insurance principles and legal obligations. Question 6. Compliance review shows that the company's average claim processing time has significantly increased over the past 2 quarters, leading to a rise in customer complaints regarding payment delays. Which of the following approaches best addresses this situation from a legal and regulatory perspective, focusing on process optimization? Option A. Conduct a comprehensive root cause analysis of claim processing bottlenecks and implement targeted procedural and technological improvements to streamline the workflow, while ensuring adherence to all state insurance regulations for claims handling. Option B. Implement stricter guidelines for claim adjusters to deny or reduce claim payouts, even for claims with strong supporting documentation, to improve financial performance. Option C. Acknowledge the increased processing times, but defer any significant process changes until the next annual operational review to minimize disruption. Option D. Immediately hire additional claims adjusters to reduce the backlog and expedite claim processing, without a detailed review of existing procedures. The correct answer is A. Conduct a comprehensive root cause analysis of claim processing bottlenecks and implement targeted procedural and technological improvements to streamline the workflow while ensuring adherence to all state insurance regulations for claims handling. Explanation. This scenario presents a common challenge in insurance operations, balancing efficiency with regulatory compliance and ethical claims handling. Core difficulty lies in identifying and rectifying systemic issues that could lead to delayed or improper claim payments, thereby exposing the company to regulatory scrutiny, financial penalties, and reputational damage. A proactive approach to process optimization is crucial to mitigate these risks. The correct approach involves a thorough, data-driven investigation into the root causes of claim processing delays. This includes analyzing claim cycle times, identifying bottlenecks, and assessing the effectiveness of current procedures and technology. The objective is to implement targeted improvements that streamline operations while ensuring adherence to all applicable laws and regulations governing claims handling. This aligns with the regulatory expectation that insurers operate with due diligence and fairness in their claims processes, as mandated by state insurance laws that often specify timelines for claim acknowledgement, investigation, and payment. Ethical considerations also demand prompt and equitable claim resolution. An incorrect approach would be to implement a superficial fix, such as simply increasing staffing levels, without understanding the underlying process inefficiencies. This might temporarily reduce backlogs, but fails to address the root causes and could lead to continued systemic problems. It also risks increasing operational costs without a proportional improvement in service or compliance. Another incorrect approach is to focus solely on reducing claim payouts, regardless of the validity of the claims. This directly violates regulatory requirements for fair claim settlement practices and can result in accusations of bad faith claims handling, leading to significant legal and financial repercussions. It also erodes customer trust and damages the company's reputation. A third incorrect approach is to ignore the compliance review findings and continue with existing processes. This demonstrates a disregard for regulatory oversight and a failure to uphold the company's legal and ethical obligations. Such an action significantly increases the risk of regulatory sanctions, fines, and potential license revocation. The professional decision-making process for similar situations should begin with a comprehensive understanding of the compliance review's findings. This involves a detailed analysis of the data and identification of specific areas of concern. Next, a root cause analysis should be conducted to pinpoint the underlying issues contributing to the identified problems. Based on this analysis, a strategic plan for process optimization should be developed, prioritizing solutions that enhance efficiency, ensure regulatory compliance, and uphold ethical standards. Continuous monitoring and evaluation of the implemented changes are essential to confirm their effectiveness and make further adjustments as needed. Question 7. Process analysis reveals that a mid-sized insurance company is experiencing increasing pressure to reduce operational costs while simultaneously facing growing threats from cyber attacks and evolving data privacy regulations. The IT department has proposed several strategies to address these challenges. Which of the following approaches best balances cost efficiency with robust cybersecurity and data privacy compliance? Option A. Implement a comprehensive cybersecurity risk assessment framework to identify, evaluate, and prioritize potential threats to sensitive data and operational systems, followed by the development of targeted mitigation strategies that align with regulatory requirements. Option B. Significantly reduce the IT security budget by cutting non-essential software licenses and outsourcing basic security monitoring to a low-cost provider to achieve immediate cost savings. Option C. Fully outsource all cybersecurity functions to a third-party vendor, assuming the vendor's expertise will automatically ensure compliance and adequate protection for all company data. Option D. Rapidly deploy new, cutting-edge cybersecurity technologies across all systems to ensure the most advanced protection, without a detailed review of their integration or specific risk profiles. The correct answer is A. Implement a comprehensive cybersecurity risk assessment framework to identify, evaluate, and prioritize potential threats to sensitive data and operational systems, followed by the development of targeted mitigation strategies that align with regulatory requirements. Explanation: this scenario is professionally challenging because it requires balancing the immediate need for operational efficiency with the long-term imperative of robust cybersecurity and data privacy, all within the specific regulatory landscape of the Insurance Company Operations Exam, LOMA 291. The exam's jurisdiction implies a focus on U.S. insurance regulations, which are stringent regarding data protection and consumer privacy. A careful judgment is required to ensure that any proposed solution does not inadvertently create vulnerabilities or violate compliance requirements. The correct approach involves a comprehensive risk assessment that prioritizes identifying potential threats to sensitive customer data and operational systems, evaluating the likelihood and impact of these threats, and then developing mitigation strategies. This aligns directly with regulatory expectations that insurers proactively manage cybersecurity risks. For instance, state insurance regulations and federal guidelines like those from the National Association of Insurance Commissioners, NAIC, emphasize a risk-based approach to data security. Ethically, this approach demonstrates a commitment to safeguarding policyholder information, a core fiduciary duty. An incorrect approach that focuses solely on cost reduction without a thorough risk assessment fails to meet regulatory mandates. Such an approach could overlook critical vulnerabilities, leading to potential data breaches that result in significant financial penalties, reputational damage, and loss of customer trust. This would violate the spirit and letter of regulations requiring adequate data protection measures. Another incorrect approach that prioritizes implementing the latest technology without understanding its specific risks and integration challenges is also problematic. While innovation is important, technology adoption must be guided by a clear understanding of how it impacts the existing security posture and compliance framework. Without a risk assessment, new technologies could introduce unforeseen vulnerabilities or conflict with existing data privacy policies, leading to non-compliance. A third incorrect approach that delegates cybersecurity entirely to an external vendor without establishing clear oversight and accountability mechanisms is equally flawed. While outsourcing can be efficient, the ultimate responsibility for data protection and regulatory compliance remains with the insurance company. Failure to maintain adequate oversight can lead to gaps in security and privacy controls, exposing the company to significant risks and regulatory scrutiny. The professional decision-making process for similar situations should involve a structured, risk-based methodology. This begins with understanding the regulatory environment, identifying all relevant data assets and systems, conducting a thorough threat and vulnerability assessment, evaluating the potential impact of identified risks, and then developing and implementing appropriate controls. Continuous monitoring and regular reassessment are also crucial components of an effective cybersecurity program. Question 8. The assessment process reveals that a life insurance company is considering a new marketing campaign that emphasizes the potential for significant cash value growth in its permanent life insurance products, using hypothetical scenarios that project high returns. The campaign materials are designed to be visually appealing and emotionally resonant, focusing on future financial security and legacy building. However, the detailed policy illustrations, which include all associated fees, charges, and the fact that cash value growth is not guaranteed and can fluctuate, are only available upon request and are not prominently featured in the initial marketing materials. Which of the following marketing and sales strategies best aligns with the regulatory framework and ethical considerations for insurance operations? A. Developing marketing materials that prominently feature the potential for cash value growth, while ensuring that detailed policy illustrations with all disclosures are readily available and clearly explained by sales agents upon inquiry. B. Creating visually engaging advertisements that highlight the aspirational benefits of permanent life insurance, with a disclaimer stating that past performance is not indicative of future results, and that policy details are available in the full contract. C. Designing a campaign that focuses on the guaranteed death benefit and the tax-deferred nature of cash value growth, with a clear statement that actual cash value performance may vary and is subject to market conditions. D. Launching a campaign that uses testimonials from satisfied customers who have experienced substantial cash value growth and encouraging immediate policy purchase to lock in current rates. Option A. Creating visually engaging advertisements that highlight the aspirational benefits of permanent life insurance, with a disclaimer stating that past performance is not indicative of future results, and that policy details are available in the full contract. Option B. Designing a campaign that focuses on the guaranteed death benefit and the tax-deferred nature of cash value growth, with a clear statement that actual cash value performance may vary and is subject to market conditions. Option C. Developing marketing materials that prominently feature the potential for cash value growth, while ensuring that detailed policy illustrations with all disclosures are readily available and clearly explained by sales agents upon inquiry. Option D. Launching a campaign that uses testimonials from satisfied customers who have experienced substantial cash value growth and encouraging immediate policy purchase to lock in current rates. The correct answer is C. Developing marketing materials that prominently feature the potential for cash value growth, while ensuring that detailed policy illustrations with all disclosures are readily available and clearly explained by sales agents upon inquiry. Explanation. The assessment process reveals a common challenge in insurance marketing, balancing aggressive sales targets with the ethical and regulatory obligation to provide accurate and non-misleading information to potential policyholders. This scenario is professionally challenging because sales representatives are often incentivized to close deals quickly, which can create pressure to oversimplify complex policy features, omit crucial details, or make promises that cannot be fulfilled. The regulatory framework for insurance operations, particularly concerning marketing and sales, emphasizes consumer protection and fair dealing. Therefore, any marketing strategy must be scrutinized for its potential to deceive or confuse consumers, ensuring that all representations are clear, accurate, and complete. The correct approach involves developing and implementing a marketing strategy that prioritizes transparency and consumer understanding. This means ensuring that all sales materials and presentations clearly articulate policy benefits, limitations, exclusions, and costs. It requires training sales agents on ethical selling practices and the specific disclosure requirements mandated by the regulatory framework. Regulatory justification stems from the principle that consumers have a right to make informed decisions. Failure to provide adequate information or engaging in deceptive practices can lead to regulatory sanctions, including fines, license suspension, and reputational damage. Ethical justification is rooted in the duty of care owed to policyholders and the commitment to building trust. An incorrect approach that focuses solely on highlighting policy benefits without disclosing significant limitations or exclusions would be professionally unacceptable. This constitutes a violation of regulations requiring full and fair disclosure, as it creates a misleading impression of coverage. Another incorrect approach, such as using testimonials that are not representative of typical customer experiences or making guarantees about future performance that are not contractually bound, also fails to meet regulatory and ethical standards. These practices can be considered deceptive advertising, undermining consumer confidence, and potentially leading to missold policies. A third incorrect approach, which involves pressuring prospective clients into immediate decisions without allowing adequate time for review and consideration, disregards the consumer's right to informed consent and can be seen as an unfair sales practice. Professionals should employ a decision-making framework that begins with a thorough understanding of all applicable regulations and ethical guidelines. Before launching any marketing campaign or sales initiative, A risk assessment should be conducted to identify potential areas of misrepresentation or consumer harm. This involves reviewing all marketing collateral and sales scripts for clarity, accuracy, and completeness. Furthermore, ongoing training and supervision of sales personnel are crucial to ensure adherence to these standards. When in doubt, seeking clarification from legal or compliance departments is a prudent step. The ultimate goal is to foster a sales environment that is both profitable and principled, prioritizing the long-term interests of both the company and its policyholders. Question 9. Consider a scenario where an insurance company's underwriting department is reviewing its guidelines for life insurance applications. The current guidelines include a criterion that assigns a higher risk score to applicants residing in certain zip codes, based on historical data indicating higher mortality rates in those areas. A junior underwriter raises concerns that this practice, while based on historical data, may disproportionately affect minority populations who are more likely to reside in these zip codes, potentially leading to unfair discrimination. The underwriting manager needs to decide how to address this concern while ensuring the company maintains sound underwriting principles and regulatory compliance. Option A. Replace the zip code criterion with a broader geographic region that encompasses a wider population, assuming this will dilute any potential discriminatory impact. Option B. Conduct a comprehensive review of the zip code criterion, analyzing the underlying data to determine if the correlation with mortality rates is actuarially sound, and if there are less discriminatory proxies for the identified risk factors, while also consulting with legal counsel on fair housing and anti-discrimination laws. Option C. Maintain the current zip code criterion, as it is based on historical data and is not explicitly discriminatory, and instruct the junior underwriter to focus on applying existing guidelines. Option D. Immediately remove the zip code criterion from all underwriting guidelines to avoid any potential for indirect discrimination, regardless of its actuarial relevance. The correct answer is D. Immediately remove the zip code criterion from all underwriting guidelines to avoid any potential for indirect discrimination, regardless of its actuarial relevance. Explanation. This scenario presents a common challenge in underwriting operations, balancing the need for accurate risk assessment with the imperative to avoid discriminatory practices. The professional challenge lies in identifying and mitigating potential biases within underwriting guidelines, without compromising the insurer's ability to price risk appropriately and maintain financial solvency, as mandated by regulatory frameworks governing insurance operations. Careful judgment is required to ensure that underwriting practices are both compliant and ethically sound. The correct approach involves a thorough review of existing underwriting guidelines to identify any criteria that may indirectly lead to disparate treatment of protected groups, even if not explicitly discriminatory. This requires understanding the intent and impact of each guideline. The regulatory justification stems from principles of fair treatment and non-discrimination, which are fundamental to insurance regulation in the U.S. Insurers are expected to develop and apply underwriting standards that are actuarially sound and do not unfairly discriminate. This approach aligns with the spirit and letter of regulations designed to protect consumers and ensure market integrity. An incorrect approach would be to ignore potential indirect discrimination, assuming that the absence of explicit discriminatory language in the guidelines is sufficient. This fails to acknowledge that seemingly neutral criteria can have a disproportionately negative impact on certain groups, leading to violations of anti-discrimination laws and regulations. Another incorrect approach is to overcorrect by removing all underwriting criteria that could potentially be linked to demographic factors, even if those factors are actuarially relevant to risk. This can lead to inaccurate risk assessment, potentially resulting in adverse selection and financial instability for the insurer, which is also a regulatory concern. Finally, an incorrect approach is to rely solely on historical underwriting practices without critically evaluating their current fairness and compliance. This can perpetuate past biases and lead to regulatory scrutiny. Professionals should employ a decision-making framework that prioritizes a proactive and evidence-based approach to underwriting guideline review. This involves 1. Understanding the regulatory landscape concerning fair practices and non-discrimination. 2. Conducting regular audits of underwriting guidelines for both explicit and implicit biases. 3. consulting with actuarial and legal experts to ensure guidelines are both compliant and actuarially sound. And 4. Establishing clear processes for addressing and rectifying any identified discriminatory practices. Question 10. The control framework reveals that a policyholder has submitted an inquiry regarding a potential discrepancy in their policy's premium calculation. The customer service representative, aiming for efficiency, believes the inquiry is likely a misunderstanding of the policy terms and can be resolved with a standard form letter. However, the representative is unsure if the standard letter fully addresses the nuances of premium calculation regulations. What is the most compliant and ethically sound approach for the representative to take? Option A. Inform the policyholder that their inquiry is considered a minor issue and will be addressed when resources permit, without providing a specific timeline. Option B. Respond with a generic statement that the policyholder should refer to their policy contract for details on premium calculations, without further investigation. Option C. Send the standard form letter immediately, as it addresses common premium inquiries and will expedite resolution. Option D. Acknowledge the policyholder's inquiry, inform them that it is being reviewed by a specialist, and provide an estimated timeframe for a detailed response, along with a direct contact for follow-up questions. The correct answer is C. Send the standard form letter immediately, as it addresses common premium inquiries and will expedite resolution. Explanation. This scenario is professionally challenging because it requires balancing the company's operational efficiency with the policyholder's right to clear and timely information, all within the confines of regulatory expectations for customer service. The core of the challenge lies in interpreting and applying the regulatory requirements for communication and complaint handling to a specific, potentially complex customer interaction. Careful judgment is required to ensure that, while efficiency is pursued, the regulatory obligations are not compromised, and the policyholder's experience reflects good faith and transparency. The correct approach involves acknowledging the policyholder's request, clearly communicating the expected timeline for resolution, and providing a direct point of contact for follow-up. This aligns with regulatory principles that emphasize prompt and accurate communication, fair treatment of policyholders, and effective complaint resolution mechanisms. By setting clear expectations and offering a dedicated contact, the company demonstrates a commitment to customer service that is both efficient and compliant, fostering trust and potentially mitigating future disputes. An approach that dismisses the policyholder's concern as a minor issue and defers it indefinitely fails to meet regulatory standards for timely response and fair treatment. This can lead to policyholder dissatisfaction, potential regulatory scrutiny for poor service, and damage to the company's reputation. Another incorrect approach, which involves providing a vague and noncommittal response without a clear timeline or designated contact, also falls short. This lack of specificity can leave the policyholder feeling unheard and undervalued, potentially escalating the issue and creating a perception of unresponsiveness, which is contrary to regulatory expectations for proactive customer engagement. Finally, an approach that attempts to resolve the issue by providing incomplete or misleading information, even if it appears to close the case quickly, is ethically and regulatorily unsound. This not only violates the principle of transparency, but also risks misinforming the policyholder, leading to potential future complications and a breach of trust. Professionals should approach such situations by first identifying the core of the policyholder's concern. They should then consult relevant internal policies and external regulatory guidelines to determine the appropriate response. This involves assessing the urgency, complexity, and potential impact of the issue. The decision-making process should prioritize clear, honest, and timely communication, ensuring that the policyholder's rights are respected and that the company operates within its legal and ethical obligations. When in doubt, seeking clarification from compliance or legal departments is a prudent step. Question 11. Stakeholder feedback indicates that certain underwriting guidelines for new life insurance product may be inadvertently discouraging applications from a specific demographic group due to their complexity and the data points required. The underwriting department is considering simplifying these guidelines by removing some data requirements and streamlining the assessment process. Which of the following actions best ensures compliance with regulatory frameworks and ethical underwriting practices? Option A. Focus on marketing efforts to target the demographic group more effectively, rather than altering the underwriting guidelines, as the current guidelines are designed to accurately assess risk. Option B. Conduct a thorough review of the existing guidelines to identify specific areas of complexity. Analyze the impact of potential simplifications on risk assessment accuracy and fairness, and consult with the legal and compliance departments to ensure adherence to all applicable insurance laws and regulations before implementing any changes. Option C. Proceed with simplifying the guidelines based on the feedback, assuming that increased application volume will naturally lead to better risk distribution and that the simplified process will be more efficient. Option D. Immediately implement the simplified guidelines to address the stakeholder feedback, with a plan to review their effectiveness and compliance retrospectively after a period of operation. The correct answer is C. Proceed with simplifying the guidelines based on the feedback, assuming that increased application volume will naturally lead to better risk distribution and that the simplified process will be more efficient. Explanation: this scenario is professionally challenging because it requires balancing the need for efficient underwriting processes with the imperative to adhere to regulatory requirements and ethical principles. Underwriting guidelines are not static. They must evolve to reflect changing risk landscapes and regulatory expectations. The challenge lies in ensuring that any updates or modifications to these guidelines are implemented in a manner that is both compliant and effective in managing risk. Careful judgment is required to avoid introducing biases, ensuring fairness, and maintaining the integrity of the underwriting process. Correct approach involves a systematic review and validation process that includes an assessment of the impact on underwriting outcomes and alignment with regulatory frameworks. This ensures that any changes are data-driven, justifiable, and do not inadvertently lead to discriminatory practices or non-compliance with established insurance laws and regulations. Specifically, it requires consulting with relevant internal departments, such as legal and compliance, to confirm adherence to all applicable statutes and guidelines governing underwriting practices. An incorrect approach would be to implement changes based solely on anecdotal evidence, or without a thorough review of their potential impact on risk assessment accuracy and regulatory compliance. For instance, making arbitrary adjustments to underwriting criteria without validating their effectiveness or ensuring they do not create unintended barriers to coverage for protected classes would be a significant regulatory and ethical failure. Another incorrect approach would be to bypass established internal review processes, such as those involving compliance and legal teams, which are designed to safeguard against regulatory breaches and ensure fair treatment of applicants. This bypass could lead to the adoption of guidelines that are not legally sound or that violate principles of equity. Professionals should employ a decision-making framework that prioritizes a comprehensive understanding of the regulatory environment, the potential impact of proposed changes on risk assessment and customer fairness, and the importance of robust internal control and validation processes. This involves seeking input from all relevant stakeholders, conducting thorough impact analyses, and obtaining necessary approvals from compliance and legal departments before implementing any modifications to underwriting guidelines. Question 12. The efficiency study reveals that a new state law has been enacted requiring insurance companies to hold significantly higher minimum reserves for all new annuity products issued after the effective date. The company's actuarial department has identified that meeting these new reserve requirements will necessitate a substantial increase in the capital allocated to these products, potentially impacting the profitability of new annuity sales and requiring adjustments to the company's overall capital management strategy. Which of the following approaches best addresses this legislative impact on insurance operations? Option A. Continue issuing annuity products under the old reserve structure for as long as legally permissible, delaying any adjustments until regulatory enforcement becomes imminent. Option B. Immediately cease offering all annuity products to avoid the complexities and costs associated with complying with the new reserve mandates. Option C. Implement a significant, across-the-board increase in premiums for all existing annuity policies to offset the anticipated increase in reserve requirements for new business. Option D. Proactively revise annuity product features and pricing for new business to align with the increased reserve requirements, while simultaneously conducting a thorough review of the company's capital allocation and investment strategy to ensure long-term solvency and profitability. The correct answer is D. proactively revise annuity product features and pricing for new business to align with the increased reserve requirements, while simultaneously conducting a thorough review of the company's capital allocation and investment strategy to ensure long-term solvency and profitability. Explanation: the efficiency study reveals that a new state law mandates a significant increase in the minimum required reserves for life insurance policies. This presents a professionally challenging scenario because it directly impacts the financial stability and operational capacity of the insurance company. Management must balance compliance with the new legislation against the need to maintain profitability and service existing policyholders. Careful judgment is required to determine the most appropriate course of action that adheres to the law while minimizing negative operational consequences. The correct approach involves a comprehensive review of the company's financial models and product pricing strategies in light of the new reserve requirements. This includes assessing the impact on solvency ratios, cash flow projections, and the potential need for capital infusion or adjustments to new business underwriting. The company should then develop a strategic plan that may involve revising product features, adjusting premium rates for new policies, and potentially reevaluating investment strategies to ensure sufficient liquidity and returns to meet the enhanced reserve obligations. This approach is correct because it prioritizes adherence to the absolute priority of regulatory compliance, as mandated by state insurance laws. Specifically, state insurance departments enforce solvency requirements, and failure to meet minimum reserve levels can lead to regulatory sanctions, including fines, suspension of license, or even receivership. By proactively addressing the legislative change, the company demonstrates responsible stewardship and commitment to policyholder protection, which is a core ethical and regulatory principle. An incorrect approach would be to ignore the new reserve requirements or to implement them in a way that creates significant operational disruption without a clear strategy. For instance, simply increasing premiums across the board for all existing policies without considering the contractual terms or the potential for policyholder lapse would be an ethically questionable and potentially legally problematic response. This fails to acknowledge the contractual obligations to existing policyholders and could violate Unfair Trade Practices Acts. Another incorrect approach would be to reduce the scope of new business offerings drastically without a thorough analysis of market demand and competitive positioning. While this might seem like a way to reduce immediate reserve strain, it could severely damage the company's long-term growth prospects and market share, and it doesn't address the fundamental need to adapt operations to meet regulatory mandates. A third incorrect approach would be to seek loopholes or engage in aggressive accounting practices to circumvent the spirit of the law. This is not only unethical, but also carries significant legal risks, including severe penalties and reputational damage. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the regulatory mandate. Thoroughly analyze the new legislation, its specific requirements, and the enforcement mechanisms. 2. Assess financial and operational impact. Quantify the effects on reserves, solvency, cash flow, and operational processes. 3. Develop strategic options. Brainstorm and evaluate various responses, considering both compliance and business sustainability. 4. Consult experts. Engage legal counsel, actuary, and financial advisors to ensure accurate interpretation and sound strategy. 5. Implement and monitor. Execute the chosen strategy and continuously monitor its effectiveness and compliance. 6. Communicate transparently. Inform stakeholders, including regulators, policyholders, and employees, about the changes and the company's response. Question 13. The monitoring system demonstrates a potential discrepancy in the processing of new policy applications that may not align with established underwriting guidelines. Which of the following is the most appropriate next step to ensure proper lines of authority and responsibility are followed? Option A. Forward the alert to the marketing department to assess its impact on sales targets. Option B. Forward the alert to the IT department to verify the accuracy of the monitoring system's data. Option C. Forward the alert to the compliance department for investigation and appropriate action. Option D. Ignore the alert, assuming it is a minor system anomaly that will self-correct. The correct answer is C. Forward the alert to the compliance department for investigation and appropriate action. Explanation. This scenario presents a professional challenge because it requires an understanding of how lines of authority and responsibility are established and maintained within an insurance company, specifically in the context of regulatory compliance, as outlined by the LOMA 291 exam framework. The challenge lies in identifying the appropriate individual or department to address a potential compliance issue, ensuring that the response aligns with established operational procedures and regulatory expectations. Careful judgment is required to avoid misdirecting the issue, delaying resolution, or creating confusion about accountability. The correct approach involves escalating the identified issue to the compliance department. This is the right course of action because insurance companies are subject to extensive regulations that mandate specific compliance functions. The compliance department is typically established with the explicit responsibility of monitoring adherence to laws, regulations, and internal policies. They possess the expertise and authority to investigate potential breaches, implement corrective actions, and report findings to senior management, and if necessary, regulatory bodies. This ensures that the issue is handled by the designated experts, maintaining clear lines of responsibility and adhering to the principle of oversight mandated by regulatory frameworks. An incorrect approach would be to ignore the alert or assume it will resolve itself. This is professionally unacceptable because it demonstrates a disregard for the company's internal controls and regulatory obligations. Such inaction could lead to significant penalties, reputational damage, and harm to policyholders if the issue is indeed a compliance failure. Another incorrect approach would be to forward the alert directly to the marketing team without further investigation. While marketing might be involved in some operational aspects, they are generally not the primary authority for investigating and resolving compliance issues. This misdirects the responsibility, potentially delaying a proper resolution and failing to engage the department equipped to handle such matters, thus violating established lines of authority. A further incorrect approach would be to address the alert solely within the IT department. While IT is responsible for the monitoring system itself, they are typically not vested with the authority or expertise to interpret and act upon compliance alerts. Their role is to ensure the system functions correctly, not to adjudicate regulatory compliance. This approach fails to recognize the specialized nature of compliance oversight and the defined responsibilities within the organization. The professional decision-making process for similar situations should involve 1. Recognizing the nature of the alert as a potential compliance issue. 2. Consulting internal policies and organizational charts to identify the department or individual with primary responsibility for compliance oversight. 3. Escalating the issue promptly to the designated authority, providing all relevant details. 4. Cooperating fully with the responsible department during their investigation and implementation of corrective actions. This systematic approach ensures accountability, efficiency, and adherence to regulatory requirements. Question 14. Process analysis reveals that the claims department is experiencing a high volume of claims, leading to concerns about both operational efficiency and the potential for undetected fraudulent activity. To optimize the fraud detection and prevention process while maintaining efficient claims handling, which of the following strategies would be most effective and compliant with operational guidelines? Option A. Increase the number of claims adjusters and rely primarily on their individual judgment and experience to identify potentially fraudulent claims during manual processing. Option B. Shift the primary focus of fraud detection to post-payment audits conducted quarterly, assuming that most fraud will be identified after payments have been issued. Option C. Integrate advanced data analytics and rule-based systems to flag suspicious claims for targeted human review, thereby enhancing detection accuracy and focusing investigative resources. Option D. Implement an automated system that immediately rejects any claim containing specific keywords associated with fraud, without further investigation. The correct answer is C. Integrate advanced data analytics and rule-based systems to flag suspicious claims for targeted human review, thereby enhancing detection accuracy and focusing investigative resources. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the need for efficient claims processing with the imperative to detect and prevent fraudulent activities. The pressure to reduce operational costs and expedite payouts can inadvertently create vulnerabilities that fraudsters exploit. A claims department must implement robust fraud detection measures without unduly delaying legitimate claims or alienating policyholders. This requires a nuanced understanding of both operational workflows and the evolving tactics of insurance fraud, all within the specific regulatory framework governing insurance operations. Correct approach analysis. The correct approach involves integrating automated data analytics and rule-based systems into the claims processing workflow. This method is right because it leverages technology to systematically scan claims for suspicious patterns, anomalies, and red flags that might indicate fraud. Such systems can analyze vast amounts of data quickly and consistently, flagging potentially fraudulent claims for further human review. This proactive, data-driven strategy aligns with regulatory expectations for insurers to maintain sound internal controls and to take reasonable steps to prevent and detect fraud. It optimizes the process by focusing human investigative resources on high-risk claims, thereby improving efficiency and effectiveness in fraud prevention without significantly impeding the processing of legitimate claims. This approach supports the insurer's duty to operate prudently and protect its assets, which are core tenets of insurance regulation. Incorrect approaches analysis. Relying solely on manual review by claims adjusters without any technological assistance is an incorrect approach. While experienced adjusters can identify some fraudulent claims, this method is prone to human error, inconsistency, and is highly inefficient for processing large volumes of claims. It fails to leverage modern fraud detection capabilities and can lead to missed fraudulent claims due to oversight or the sheer volume of work. This approach does not meet the regulatory expectation of implementing reasonably effective systems for fraud detection. Implementing a system that automatically rejects any claim flagged by a basic keyword search for suspicious terms without further investigation is also an incorrect approach. This is overly simplistic and can lead to the wrongful rejection of legitimate claims, causing significant customer dissatisfaction and potential regulatory scrutiny for unfair claims practices. It lacks the necessary sophistication for accurate fraud detection and fails to provide due process for policyholders. Focusing exclusively on post-payment audits to identify fraud is an incorrect approach. While audits are valuable, they are reactive. This strategy misses the opportunity to prevent fraudulent payments from occurring in the first place, leading to unnecessary financial losses for the insurer. Regulatory frameworks generally encourage proactive fraud prevention measures rather than solely relying on retrospective detection. Professional reasoning. Professionals in insurance operations must adopt a risk-based approach to fraud detection and prevention. This involves understanding the potential financial and reputational impact of fraud and implementing controls commensurate with that risk. The decision-making process should prioritize strategies that are both effective in identifying fraud and efficient in processing legitimate claims. This requires staying abreast of technological advancements in fraud detection, understanding regulatory expectations, and continuously evaluating and refining internal processes. A commitment to ethical conduct and customer service should guide all decisions, ensuring that fraud prevention measures do not compromise the insurer's obligations to its policyholders. Question 15. The evaluation methodology shows that a life insurance company is preparing to launch a new annuity product in a specific U.S. state. To ensure regulatory compliance, which of the following actions is the most appropriate and legally sound? Option A. Conduct a comprehensive review of the new annuity product's features, marketing materials, and policy forms against the specific insurance statutes and administrative rules of the target state's Department of Insurance. Option B. Prioritize the rapid deployment of the new annuity product to gain a competitive advantage, with a plan to address any potential regulatory issues that may arise post-launch. Option C. Rely on the company's existing compliance protocols for annuity products, assuming they meet the general standards for insurance operations across all U.S. states. Option D. Assume that the product's compliance with federal regulations is sufficient to meet the requirements of individual U.S. states. The correct answer is A. Conduct a comprehensive review of the new annuity product's features, marketing materials, and policy forms against the specific insurance statutes and administrative rules of the target state's Department of Insurance. Explanation. This scenario is professionally challenging because it requires an insurance company to navigate a complex regulatory environment where compliance is not just a legal obligation, but also crucial for maintaining public trust and operational integrity. The pressure to meet deadlines while ensuring adherence to specific state insurance laws as mandated by the LOMA 291 curriculum, necessitates a rigorous and systematic approach to regulatory compliance. Misinterpreting or overlooking specific state requirements can lead to significant penalties, reputational damage, and disruption of business operations. The correct approach involves a thorough review of the specific state's insurance regulations pertaining to the new product launch. This means identifying all applicable statutes, administrative rules, and bulletins issued by the state's Department of Insurance. The company must then ensure that the product design, marketing materials, and policy provisions strictly align with these state-specific requirements. This proactive and detailed compliance strategy is essential because insurance is a heavily regulated industry, and each state has its own unique set of rules designed to protect consumers and ensure the solvency of insurers. Adhering to these specific mandates is a fundamental ethical and legal responsibility. An incorrect approach would be to rely solely on general industry best practices or the company's internal compliance standards without verifying their alignment with the specific state's laws. This is a regulatory failure because it assumes a one-size-fits-all compliance model, which is rarely effective in the fragmented U.S. state-based insurance regulatory system. Another incorrect approach would be to prioritize speed to market over comprehensive regulatory review. This is an ethical and regulatory failure, as it demonstrates a disregard for consumer protection laws and the authority of the state insurance regulator, potentially exposing the company to fines and sanctions. Finally, assuming that compliance in one state automatically translates to compliance in another is a significant oversight, as each state's regulatory framework is distinct and must be addressed individually. Professionals should employ a decision-making framework that begins with identifying the specific regulatory jurisdiction involved. This is followed by a detailed research phase to understand all applicable laws and regulations. Next, a gap analysis should be performed to identify any discrepancies between the proposed product or operational change and the regulatory requirements. Finally, a remediation plan should be developed and implemented to ensure full compliance before proceeding. This systematic process ensures that all regulatory obligations are met, minimizing risk and upholding ethical standards. Question 16. The efficiency study reveals that the current core insurance processing system is outdated and hindering operational agility. The IT department proposes a comprehensive upgrade to a new, cloud-based platform that promises significant improvements in data analytics, customer service, and policy administration. However, the migration of sensitive policyholder data to the new system presents substantial security and privacy challenges. The company must decide on the best strategy for implementing this upgrade, while ensuring compliance with all applicable insurance regulations regarding data protection and operational integrity. Which of the following approaches best balances the need for technological advancement with regulatory compliance and data security? Option A. Conduct a phased migration of policyholder data to the new system, with rigorous data validation, encryption, and security testing at each stage, and establish a dedicated team to oversee the entire process. Option B. Outsource the entire data migration process to a third-party vendor that offers the lowest cost, assuming they will manage all security and compliance aspects. Option C. Implement the new cloud-based system immediately across all operations to realize efficiency gains as quickly as possible, relying on the vendor's standard security protocols. Option D. Postpone the upgrade indefinitely until a completely risk-free migration solution can be identified, continuing to operate with the current inefficient system. The correct answer is C. Implement the new cloud-based system immediately across all operations to realize efficiency gains as quickly as possible, relying on the vendor's standard security protocols. Explanation: this scenario is professionally challenging because it requires balancing the need for technological advancement and operational efficiency with the paramount duty to protect sensitive customer information, as mandated by insurance regulations. The company must navigate the complexities of data security, privacy laws, and the potential for system vulnerabilities introduced by new technologies. Careful judgment is required to ensure that any IT upgrade not only enhances operations, but also maintains compliance and customer trust. The correct approach involves a phased implementation of the new core processing system, prioritizing robust data migration protocols, and comprehensive security testing at each stage. This aligns with regulatory expectations for prudent risk management and data protection. Specifically, it addresses the need for secure handling of policyholder data throughout the transition, minimizing the risk of breaches or unauthorized access. Regulatory frameworks typically require insurers to have adequate systems and controls in place to safeguard sensitive information, and a phased, secure approach demonstrates due diligence in meeting these obligations. An approach that immediately deploys the new system without thorough testing of data integrity and security protocols would be a significant regulatory failure. This bypasses critical risk assessment steps, potentially exposing policyholder data to unauthorized access or corruption, which violates data privacy and security mandates. Another incorrect approach, focusing solely on cost reduction by outsourcing data migration to a vendor with less stringent security certifications, would also be a regulatory failure. Insurers remain ultimately responsible for the security of policyholder data, regardless of whether it is handled internally or by a third party. Failing to ensure the vendor meets required security standards constitutes a breach of fiduciary duty and regulatory noncompliance. Finally, an approach that delays the implementation indefinitely due to minor technical glitches, without a clear plan for resolution and continued operational risk assessment, would be professionally unsound. While caution is necessary, prolonged inaction can lead to operational inefficiencies and potentially expose the company to other risks if existing systems become outdated and vulnerable. The professional decision-making process for such situations should involve a thorough risk assessment, consultation with IT security experts and legal counsel, and a clear, documented implementation plan that prioritizes data security and regulatory compliance at every step. This includes establishing clear metrics for success and contingency plans for potential issues. Question 17. Governance review demonstrates that the insurance company's operational structure is currently highly decentralized, with significant autonomy granted to regional offices in areas such as underwriting, claims handling, and policy administration. The review also highlights potential inconsistencies in the application of internal policies and a lack of uniform risk management practices across different branches. Considering the regulatory framework for insurance company operations, which structural adjustment would best enhance compliance and operational integrity? Option A. Centralize key compliance functions, underwriting authority for complex cases, and the development of standardized operational procedures, while allowing regional offices some flexibility in customer service delivery within established guidelines. Option B. Fully decentralize all operational decision-making, empowering regional managers to set their own underwriting guidelines and claim settlement protocols based on local market conditions. Option C. Maintain the current decentralized structure, but implement enhanced training programs for regional staff on existing policies and procedures. Option D. Centralize all operational functions, including day-to-day customer service interaction, to ensure absolute uniformity across the entire organization. The correct answer is A. Centralize key compliance functions, underwriting authority for complex cases, and the development of standardized operational procedures, while allowing regional offices some flexibility in customer service delivery within established guidelines. Explanation. This scenario presents a professional challenge because it requires balancing operational efficiency with regulatory compliance and the need for consistent, ethical decision-making across an organization. The choice between centralized and decentralized structures has significant implications for how policies are implemented, how risks are managed, and how effectively the company can respond to regulatory changes. Careful judgment is required to select the structure that best supports the company's objectives while adhering to the strict requirements of the Insurance Company Operations Exam, LOMA 291. Jurisdiction. The correct approach involves adopting a centralized structure for key operational and compliance functions. This is because a centralized model ensures uniform application of policies and procedures across all departments and locations. For an insurance company operating under the specified regulatory framework, this uniformity is critical for demonstrating compliance with regulations that often mandate consistent treatment of policyholders and standardized reporting. A centralized approach facilitates robust internal controls, simplifies audits, and allows for more effective oversight by senior management and regulatory bodies. It directly supports the principle of consistent operational standards, which is a cornerstone of sound insurance company governance and regulatory expectation. An incorrect approach would be to adopt a fully decentralized structure for compliance and operational decision-making. This would lead to inconsistencies in policy interpretation and application, increasing the risk of regulatory breaches. For example, if each regional office independently determined its approach to underwriting or claims processing without central oversight, it would be difficult to ensure adherence to national standards or to identify systemic risks. This fragmentation undermines the ability of the company to present a unified and compliant front to regulators. Another incorrect approach would be to implement a hybrid model where critical compliance functions are decentralized, but operational decisions are centralized. This creates a disconnect. Compliance requirements, such as data privacy or anti-money laundering protocols, often necessitate centralized oversight and standardized procedures to be effective. Decentralizing these functions while centralizing operational decisions would create a situation where the how of operations might be standardized, but the rules governing those operations are not, leading to potential gaps in control and compliance. The professional decision-making process for similar situations should involve a thorough assessment of the company's specific operational needs, risk appetite, and the regulatory landscape. Professionals should first identify the core functions that are subject to stringent regulatory oversight and require uniformity. For these functions, a centralized approach is generally preferred. For other operational areas where local market conditions or specific customer needs might warrant flexibility, a degree of decentralization might be appropriate, but always within a framework of clear central guidelines and oversight. The key is to ensure that any decentralized elements do not compromise the company's overall compliance posture or its ability to meet its obligations to policyholders and regulators. Question 18. System analysis indicates that an insurance company is planning to expand its underwriting into a new, higher-risk product line. The underwriter is tasked with ensuring that the company's existing reinsurance treaty adequately supports this expansion. Which of the following approaches best aligns with prudent underwriting and regulatory compliance in this situation? Option A. Proceed with underwriting the new product line, assuming the existing reinsurance treaty will automatically provide adequate coverage and address any shortfalls only if losses exceed expectations. Option B. Focus solely on negotiating the lowest possible ceded premium for the new product line, regardless of the specific coverage details or the treaty's impact on underwriting capacity. Option C. Review the existing reinsurance treaty to confirm if its terms and conditions provide sufficient coverage for the anticipated risks and volumes of the new product line, and if necessary, negotiate amendments or seek additional reinsurance. Option D. Rely entirely on the reinsurer's assurance that the existing treaty is sufficient for the new product line, without conducting an independent internal assessment of coverage and capacity. The correct answer is C. Review the existing reinsurance treaty to confirm if its terms and conditions provide sufficient coverage for the anticipated risks and volumes of the new product line, and if necessary, negotiate amendments or seek additional reinsurance. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the immediate need to manage risk exposure with the long-term implications of reinsurance treaty terms on the company's overall underwriting strategy and financial stability. The underwriter must not only understand the mechanics of reinsurance, but also its strategic role in supporting profitable growth and maintaining solvency, all within the specific regulatory framework governing insurance operations. Careful judgment is required to ensure that the chosen reinsurance approach aligns with the company's risk appetite, capital position, and regulatory compliance obligations. The correct approach involves a thorough review of the existing reinsurance treaty's terms and conditions, specifically focusing on how they impact the underwriting of new business and the management of in-force business. This includes assessing whether the treaty adequately covers the types and volumes of risks the company intends to underwrite, and if the ceded premiums and recovery provisions are financially sound and strategically beneficial. This approach is right because it directly addresses the core function of reinsurance in underwriting, risk transfer, and capacity enhancement. By ensuring the reinsurance treaty supports the underwriting strategy, the underwriter is fulfilling their duty to protect the company's financial health and comply with regulatory requirements that mandate prudent risk management and solvency. This proactive assessment ensures that reinsurance is a tool for strategic growth and risk mitigation, rather than a reactive measure that could lead to unexpected losses or regulatory scrutiny. An incorrect approach would be to prioritize securing the lowest possible ceded premium without a comprehensive understanding of the treaty's coverage limitations or its impact on the underwriting of specific risk classes. This failure stems from a myopic focus on cost reduction, neglecting the critical aspect of adequate risk transfer. Regulatory failure here lies in potentially exposing the company to unmanaged risks that could jeopardize solvency, a key regulatory concern. Another incorrect approach would be to assume that the existing reinsurance treaty automatically aligns with new underwriting initiatives without any review. This passive stance ignores the dynamic nature of underwriting and reinsurance, can lead to situations where new business is underwritten with the expectation of reinsurance coverage that is either insufficient or not applicable, resulting in unexpected capital strain and potential regulatory noncompliance with solvency requirements. A further incorrect approach would be to solely rely on the reinsurer's recommendations without independent due diligence and internal assessment. While reinsurers offer expertise, the ultimate responsibility for prudent risk management and compliance rests with the insurer. Over-reliance without internal validation can lead to accepting treaty terms that do not align with the insurer's specific risk appetite or regulatory obligations, potentially leading to financial distress and regulatory sanctions. The professional decision-making process for similar situations involves a systematic evaluation of reinsurance's role in underwriting. This includes 1. Understanding the company's strategic underwriting objectives and risk appetite. 2. Analyzing the current reinsurance program's capacity, coverage, and cost in relation to these objectives. 3. Assessing the impact of any proposed changes to underwriting on the existing reinsurance arrangements. 4. Evaluating potential new reinsurance structures or treaty amendments to ensure they provide adequate protection and support profitable growth, while remaining compliant with all applicable regulations. 5. Documenting the rationale for all reinsurance decisions, demonstrating due diligence and adherence to regulatory standards. Question 19. The audit findings indicate that the claims department is experiencing significant backlogs, leading to delays in processing and paying out legitimate claims. Management is considering implementing a temporary policy to prioritize claims that are less complex or have a lower payout amount to improve the department's efficiency and cash flow in the short term, while larger or more complex claims are addressed at a slower pace. What is the most appropriate course of action for the insurance company to take in response to these audit findings? Option A. Acknowledge the audit findings and immediately allocate additional resources, including temporary staff or overtime, to address the claims backlog across all claim types, ensuring fair and timely processing for all policyholders. Option B. Immediately implement the temporary policy to prioritize simpler claims, while continuing to work on more complex ones to improve overall processing speed and cash flow. Option C. Inform policyholders with larger or more complex claims that their payouts will be delayed due to operational challenges and offer a small goodwill payment for the inconvenience. Option D. Focus on reducing the number of claims being paid out by implementing stricter review processes for all claims, regardless of complexity, to mitigate financial exposure. The correct answer is B. Immediately implement the temporary policy to prioritize simpler claims, while continuing to work on more complex ones, to improve overall processing speed and cash flow. Explanation. This scenario presents a professional challenge, because it requires balancing the immediate financial pressures of the company with the long-term ethical and regulatory obligations to policyholders. The audit findings highlight a potential conflict between operational efficiency and the duty of utmost good faith, a cornerstone of insurance regulation. Navigating this requires a deep understanding of the regulatory framework governing insurance operations and a commitment to ethical conduct. The correct approach involves prioritizing the prompt and accurate processing of claims, even if it temporarily strains resources. This aligns with the regulatory expectation that insurance companies act in the best interest of their policyholders and uphold the principle of utmost good faith. Specifically, regulations typically mandate fair and timely claim handling, and any delay or denial without proper justification can lead to regulatory scrutiny, fines, and damage to the company's reputation. This approach demonstrates a commitment to fulfilling contractual obligations and maintaining customer trust, which are essential for long-term business sustainability. An incorrect approach that suggests delaying claim payments to improve short-term cash flow would be ethically and regulatorily unsound. This action directly violates the duty of utmost good faith and could be construed as a breach of contract. Such a delay, especially if not communicated transparently and with valid reasons, can lead to policyholder dissatisfaction, complaints to regulatory bodies, and potential legal action. Furthermore, it erodes the foundational trust between the insurer and the insured. Another incorrect approach, which involves selectively processing claims based on their perceived impact on profitability, is also unacceptable. Insurance contracts are based on risk pooling and the promise of protection, not on the insurer's ability to profit from individual claims. This selective processing undermines the principle of fairness and equity that underpins the insurance industry. It can lead to accusations of discriminatory practices and a loss of confidence in the company's integrity. A professional decision-making process in such situation should involve a thorough review of the audit finding against the specific regulatory requirements for claim handling and consumer protection. It necessitates an assessment of the potential impact on policyholders and the company's reputation. When faced with operational challenges, the focus should be on finding solutions that do not compromise ethical standards or regulatory compliance, such as reallocating resources, improving internal processes, or seeking temporary external support, rather than resorting to practices that disadvantage policyholders. Question 20. Risk assessment procedures indicate that an insurance company offers a range of financial protection products. One product provides a lump sum payment upon the death of the insured, while another covers the cost of medical treatments for illness and injury. A third product insures against damage to a vehicle due to an accident, and a fourth covers liability for damages caused to others by the insured's actions. Which of the following best describes the regulatory classification of these distinct product offerings for the purpose of operational oversight? Option A. All products would be managed under a single, generalized insurance regulatory framework due to their common purpose of providing financial protection. Option B. The company should consolidate all offerings under a single operational license, treating them as a diversified financial services entity with minimal specific product regulation. Option C. The products would be classified based on their primary sales channel, with all products sold through agents falling under one set of rules and those sold directly under another. Option D. The products would be regulated as life insurance, health insurance, property insurance, and casualty insurance, respectively, each subject to specific statutory requirements. The correct answer is D. The products would be regulated as life insurance, health insurance, property insurance, and casualty insurance, respectively, each subject to specific statutory requirements. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance company to accurately categorize its operations and product offerings to ensure compliance with the distinct regulatory frameworks governing different types of insurers. Misclassification can lead to significant legal, financial, and reputational consequences, including regulatory sanctions, fines, and loss of operating licenses. The core challenge lies in understanding the nuanced differences between life, health, property, and casualty insurance products, and how these distinctions dictate regulatory oversight. Correct approach analysis. The correct approach involves a thorough review of the company's existing and proposed product lines, identifying the primary risks being insured and the nature of the benefits provided. For instance, products that provide death benefits or long-term income replacement due to disability fall under life and health insurance regulations, respectively. Conversely, products covering damage to physical assets or liability arising from accidents are classified as property and casualty insurance. This meticulous product-by-product analysis ensures that the company adheres to the specific solvency, consumer protection, and operational requirements mandated by regulators for each distinct insurance sector. This aligns with the principle of regulatory compliance, ensuring that the company operates within the legal boundaries set for its specific business activities. Incorrect approaches analysis. An incorrect approach would be to assume that all insurance operations can be managed under a single, generalized regulatory framework, ignoring the specific mandates for life, health, property, and casualty insurers. This oversight fails to recognize that regulators establish distinct rules for each type of insurance due to the varying risk profiles, claim patterns, and consumer protection needs associated with each. For example, treating a life insurance policy, which involves long-term mortality risk, with the same regulatory scrutiny as a property insurance policy, which covers short-term physical damage, would be a critical error. Another incorrect approach would be to prioritize operational efficiency or cost savings over accurate regulatory classification, leading to a superficial assessment of product types. This disregard for regulatory precision can result in non-compliance, as the company would not be meeting the specific capital requirements, reserving practices, or disclosure obligations pertinent to each insurance category. Professional reasoning. Professionals should adopt a systematic approach to regulatory compliance by first identifying all product lines and services offered. For each product, they must then determine the primary risk being insured and the nature of the benefit. This information should be cross-referenced with the specific definitions and classifications provided by the relevant insurance regulatory bodies. If a product straddles multiple categories, a deeper analysis is required to determine the predominant classification or to ensure compliance with the most stringent applicable regulations. Regular review and updates of this classification are essential, especially when new products are introduced or existing ones are modified. This proactive and detailed approach ensures that the company operates legally and ethically, safeguarding both its financial stability and the interests of its policyholders.